Alright guys, the first Forex video for the SupremeCommerce Training YouTube channel. So I've been doing Forex since 2017, and now that as of early spring 2020, we now offer Forex training and alerts. So what we've done is obviously gone into all the people that are providing Forex alerts and training, and what we've done is, so for the most part, you're going to be getting like 3 to 5, upwards of 10 alerts a week from most traders, like professional traders that provide alerts. And then you're going to be paying like 60, 80, 100, 150, $200 a month. So what we did is 57 bucks a month, and we're sending like 5, 10, 15, sometimes 20 alerts per week. And our overall goal is not a daily or a weekly goal, it's a monthly goal of 10 to 50% gains every month. So we've achieved that in the last 2 months that we've been offering the alerts. And depending on account size, risk size, lot sizes, all this, there's a bunch of different factors that vary that will give you like how much you're going to gain in a month. Actually depends on the lot sizes, which is your risk, which is the risk to how large your trade account is. So like if someone has a $500 trade account and they're just starting, I wouldn't recommend doing larger lot sizes, right? The larger the lot size, the larger the risk, the easier it is for you to blow your account. And people, new Forex traders like to think, well, if I do a larger lot size, I take a bigger risk, I can make more money. You can also lose a lot more money. You can lose your entire account, right? So it's definitely better. So what we're going to do is go over some trade strategies. Now, there's a lot of controversy and a lot of different traders with a lot of different opinions and a lot of different things around trade strategies and what's the best, what's not the best. So in my opinion, combination trade strategies is the best. Now, and again, that might sound, if you understand trading, some people would say, well, stick to one strategy and that's it. Well, a combination strategy is still one strategy, and it's the best, in my opinion, the best way to trade is because you're taking and I don't mean strategies based off indicators. So I'm not talking about like using RSI and then, support and resistance, like indicators that help you find an entry for a trade, because number one, no single indicator should ever be used to choose your entry on a trade, right? I mean, one out of 100 times you'll be able to use a single indicator to enter a trade, but that's only if that's the final indicator you're using, because everything else with the trade you're about to enter lines up with your trade strategy. So a combination trade strategy is, in my opinion, the best way to trade. And a good example of a combination trade strategy is you're not going to be able to develop a combination trade strategy until you understand the fundamentals of Forex and the multiple different ways that you can trade. So some of the main ways that modern traders are doing day trading and Forex trading, whether it's stocks, indices, commodities, or Forex, whatever it is going to be following trends. And then there's support and resistance, and obviously candlestick trading. And then there's the 3 market phases, which is actually the most sound way to understand how the market moves. And a lot of traders don't actually understand the 3 market phases and how to utilize this in their trade strategy. And if you're not using the 3 market phases in your trade strategy, you're going to have a lower success rate. So if you're incorporating the 3 market phases, which is always happening no matter what. The crazy thing is the 3 market phases, they're called market phases for a reason, because they are solidified, and these market phases are always happening no matter what. No matter where you look, no matter how far back in the past you look, no matter if you're just looking at today, last week, the last month, the last 5 years, there is 3 market phases that are always moving, and depending on what currency pair or what commodity or index or stock you're looking at, it could be in a different market phase depending on what time of day it is and how that pair or stock or whatever is moving. So if we're looking at, this is DE30, which is the German national index or index, the DE30 index. This is, you can see right here, it's a W pattern, and it's almost forming another little one. So if you were to say, let's say, okay, support and resistance. So support and resistance would be, I like to just use trend lines. So support and resistance, if you wanted to find a resistance on what we're looking at right here, so what we could do, hold on, let me get rid of that. If I go back, we actually have some resistance here. So if I grab this line that I was going to use for my support and resistance, drop it right there, grab it and extend it over here. Let's see. Okay, that's pretty close to that same level of resistance. So it didn't quite come down here, but this is also really far back, right? Like that's like a couple weeks back, a week or two. So if we are to start a new resistance line, I mean, a resistance forms is once it goes back and forth and bounces off the same spot more than once, right? So a better line of resistance could probably be like right here. So if you look right here, we had a line of resistance right here. This is actually during a consolidation phase or market phase 1. Right here, where the price seemed to level out a little bit, that's usually called a consolidation, or market phase 1, which is the worst time to enter a trade, is during market phase 1 or during a consolidation. So if you look over here, this one wick did peak past the support line, but this is a general line of support right here. Now, if you see here, it didn't actually come up to the support there, but it came down. So if you were to try to draw a support line here, so up here up the top would be a resistance and at the bottom would be support. So if you were to try and draw a support line here, thinking, oh, look, it bottomed out here, so I'm going to draw a support line, right? Or I'm going to use a support bar. But look right here, what happens? First thing is, another thing is candlestick trading and price action. Price action is extremely important. So if you see right here, the candles started to get a little bit smaller, and that's generally showing you price action. So when it starts to, and there's actually a little bit of resistance over here right at this level, and right around here is when it actually started to, the candles started to get a bit smaller, but they don't really have long wicks. There is some wicks at the bottom of there showing there is some form of resistance. But if you were to try to say, hey, this is my line of resistance or support, and then you draw your support bar right here, and you tried to enter a trade at the bottom here, a buy trade, thinking it's going to go up, well, take a look. It actually went down. Why? Because you need to have two times, right? It's better to find two locations where it hit a support or resistance line for you to actually draw your support or resistance line. And as you can see, if I was to try to do support and resistance trading in the last 2 days on DE30, there isn't any really strong or solid support and resistance lines here, right? Not really great. I mean, I could come down here and predict that maybe this could be a new support line, or right? But I can't really predict that. The next closest thing we have is right up here. So it bounced off here, went back up, bounced off there, and now it's kind of consolidating. It's slowly starting to come back down. It's starting to enter market phase 2. So this right here is a market phase 1. Right here, we're actually in the beginning of market phase 2, which is the initial market movement after a consolidation. Consolidation phase is basically market phase 1. After market phase 1 is market phase 2. Market phase 2 is another spot where a lot of traders, and where we call it the dumb money, people that lose a lot more of their trades than they do win, are entering the trades here thinking, oh, it just came out of the spot, now it's moving down. And they're going to guess, oh, it's probably going to keep going down. But just based off of it coming out of a consolidation or a market phase 1 doesn't actually give you a strong enough indicator of which direction it's going to go. But if you come up here, right, it consolidated here, and maybe this wick was the first wick to come, so maybe it started coming down. And I bet you there's a decent amount of traders that as soon as it came out of this console, it started to move down. Maybe people try to do some sell orders, thinking that it's going to go down, but look what happened. After market phase 1 was completed, market phase 2 and market phase 3 is the big movement where all the smart money is being invested. It actually went up. Market phase 1 again, console. Market phase 2 began. Market phase 3, it dropped down. Right? So understanding the 3 market phases, market phase 1 is a console. So right here would be market phase 1. Right here would be a market phase 1. Right here would be a market phase 1. What comes after 1 is 2. So after 1 comes 2. So market phase 2 would have began here. Right? And let's say this was our last form of resistance, this line right here. So market phase 2 would have ended as soon as this line was crossed. So here's market phase 1. Here's the tail end of market phase 2, right here. Right where it broke past this last line of resistance, right? In a good line of resistance, it doesn't need to have, once you got a lot of wicks on a 1 hour or 4 hour bars, if there's a ton of wicks, right, and then it consoles, definitely not a good idea to enter the trade, but it does give you an idea there's some resistance at the bottom. But take a look. As you can see, so support and resistance traders, they'd have seen this resistance. There's a pretty decent chance they probably would have bought. So if they buy, they want it to go up, right? So after the spot, it goes up. Did it go up? No, it did not go up. It went down, right? It went down. So this is why the best time to enter a trade is during market phase 3. Market phase 3 is the best time to enter a trade. Now, you may miss out on some pips, entering in market phase 3, once the market phase 1 and 2 are over with and the market is doing a solid movement, this is not called predicting the market. This is called taking a trade when you know where the market's going, right? You don't know exactly how far it's going to go, but this is where you tie in a combination trade strategy. So the very first thing you need to know is obviously fundamentals, price action, some basic stuff like some candlestick patterns, some support and resistance, and obviously being able to follow a trend. I don't like to do trades based on trend patterns. My trade strategy is follow all 3 market phases, and then I wait for market phase 3, and I wait to see which direction it's going. I also look at historical data, so the last few days, even the last like 2 weeks. I'll even look further back than that if I'm looking to do a swing trade. I will look even further back to see what happens at this price zone in history. Is there any historical data like a long time ago that shows me any indication of what this currency pair or indice or whatever or stock does when it's around this price zone? Right? So if there's any huge indicators that show you, oh, well, it likes to do this or it likes to do that when it's in this price zone, then you can fast forward to where you're trying to enter your trade and go, okay, based on historical data, I know this and I know that. Right, so you know maybe around this maybe this is a very strong resistance area in the past, right? So if this is a really strong resistance area or support, right? If this was a very strong support in the past, there is a pretty decent chance this could have bounced off and went up, right? But it never did. So after market phase 1, console, market phase 2 began, the movement started to go down, and let's say market phase 2, right? A lot of people entering trades around here thinking it's going to go down. And in this case, they would have been right because it did go down. But if we go back here, enter the console market phase 1 here, and let's say this wick has started to go down and people try to enter sell trades here, thinking it's going to keep going down because this is actually a downward trend. And as you can see right here, another reason why I don't like to just do support and resistance for my trades, I don't only follow price action and I don't follow trends, right? The trend is down, as you can see right here, right? The trend is down. So if let's say we enter this console here and then it started to move down again, I bet you there's a lot of traders that are opening up sell orders thinking, oh, well, it just broke the trend line, right? So if I draw a trend bar, if I take this right here and I draw downwards, let me actually move it right here. And I draw this down, so I'm going to try and touch the top as many wicks as I can. So if I go right here, let's get rid of this one. So if I go here and I draw this trend line down, let's see if I can zoom in a little bit. So let's say we're following this trend down, and it breaks the trend pattern, right? It broke right here. But as you can see in this console zone, it started to actually go down here on this wick a little bit. It did go up too. But let's say a lot of traders are watching this spot right here, right? And at this spot, it's actually with RSI is a relative strength indicator. It literally is an indicator that tells you, it's almost like your own support and resistance without you having to figure out and draw lines for support and resistance yourself. The RSI will show you that. It will show you, based on historical data, what some indicators are on basically support and resistance. So there's so much to go into. I'm trying not to get tripped up because now I'm talking about RSI. What I'm trying to show you is trend patterns, market phase 1 in a console, and where a lot of traders are making mistakes. That's what I'm trying to show you because that is more important than understanding RSI. It's more important than understanding trend patterns. It's more important than understanding how to figure out where your support and resistance are. These things I'm showing you in this video is a lot more important than those small factors. But those factors, over time, once you develop your trade strategy, it's important for you to understand all those fundamentals so you can incorporate them into your combination trade strategy. So like I said, I like to go off the 3 market phases and I only enter in the beginning or even slightly partway through market phase 3 when I know where the market's going. I don't like to try to predict where it's going based off of a trend pattern or based off of RSI alone or based off of support and resistance if I think it's going to bounce off or not. Because as you can see right here, it's really nice that we're looking at this right here, because if you were to follow trend down, As you can see, it did not continue to follow trend when it tried to bounce back down. It actually went up, opposite direction. Anyone who opened a sell order here lost their money. A lot of sellers anyways, unless they closed out early because they realized it was going back up. Right, so opening a sell order here, you lose money. Right, coming out of the console here. Okay, so let's say right here, market phase 2, after market phase 1, which is right here, market phase 2, it starts to go up. There isn't much of a... The market phase 3 was a small entry here, so you would have been able to do a scalp trade, but not a swing trade or even a full day trade. With the market phase 3 here, it was a very small movement. So in this case, right, people might have been opening buy orders right around here once they've seen it going up. But take a look. Let's say they open a buy order here and they leave their trade open. Look what actually happened. It ended up going down further than where it was before when it consolidated. Right? So there's a potential to lose money there too. So I'm trying to point out all the areas where you can lose money trying to do support and resistance. Lose money just trying to follow a trend. Lose money just going based off price action or just based off of RSI. Right? You can win more than 50% of your trades. And the crazy thing is, this is how most traders develop their trade strategy. There's candlestick traders, so they're literally just follow candlestick patterns, and then they use like support and resistance, maybe the RSI, and that's how they make their decisions to enter a trade. They do not understand the 3 market phases. And no, understanding consolidation doesn't mean you understand all 3 market phases, right? And you can win more than 50% of your trades. And this is why a lot of traders, multi-million-dollar traders, I mean, people that do extremely well, they have to understand how the market actually moves as a whole. And this is why it's better to follow less pairs, like fewer pairs, like 2, 3, 4, 5. I would focus on 1 or 2 in the very beginning, maximum 3. And once you've mastered how the market moves with those favorite currency pairs or whatever it is that you're following, once you've mastered how those move and you become a good trader using those fewer pairs, then you can move on and open up your portfolio to following how other new pairs move. So you can be a better trader overall, because then you'll be able to hedge naturally by opening up trades on multiple pairs. You're hedging your other trades, and you're also increasing your opportunity for larger gains by trading on more pairs. But another common mistake new traders make is they'll try to like right here, here's a bunch of different currency pairs that I'm looking at. They'll try to look at every single one, right? There's like 30 here. Try to look at every single one and try to find a trade opportunity without having ever followed this currency pair for more than a day or a few weeks. I'm just going to cycle between all these different pairs until I think I found an opportunity. And that isn't a great way to lose the majority of your trades and eventually lose your hat trading. It's better to become really good at a few, and over time, add a few more in over time to your portfolio as you get really good with a few. Once you're profiting and you're making money as a trader, that should be the only time you decide you want to add in more currency pairs or stocks or whatever is you're trading. That'd be the only time to incorporate more, is once you're good at it. That's like selling on Amazon and then eBay and then Etsy and then Shopify all at the same time. You're going to be overloaded, overwhelmed, because Amazon is different from Etsy. Etsy is different from Shopify. All the strategies in e-commerce are different from each other, selling on these different marketplaces. Now, they're similar, but they are different. Having to become a master of all those at the same time, it's going to be really difficult, right? Same with trading multiple pairs or multiple stocks or whatever. So you need to focus on fewer, and you need to understand the 3 market phases. So I'm not going to go too in-depth on support and resistance. As you see, I haven't really gone in-depth on it. I'm not going to go in-depth on trend. I'm not going to go in-depth on breakout trade strategies. And a breakout could have been like right here. Here's the trend going down, and this was a little bit of a breakout. Actually, to me, it was more like a retest. It went up, and it actually continued to go back down on trend. Now, if I was to take this trend line and move it, right, try to follow a trend pattern. Here we go. So I'm touching more wicks, right? And here, it broke this trend pattern, right? It went above this line. If I was to extend this line out, the trend pattern's going this direction, down, right? And it broke it here. Some traders might have been, oh, it's probably a retest. So instead of selling, right, they're going to try to buy. Or instead of buying, because it's going up, they're going to try to sell. So they're going to wait for a high point and then sell. Right? That's a breakout or retest strategy. So if I'm going to go based off retest, so here's the trend line, right? Breakout, there's nothing wrong with a breakout trade following breakouts, and nothing wrong with trying to follow and anticipate retests and enter your trade. But doing those, you literally got to watch the markets like a hawk. And no one has 10 hours a day to sit there and stare at one currency pair when you're actually there to make money and not just make money on one pair. So understanding the 3 market phases, the retest and the breakouts and the fake outs and the trend patterns, none of that shit matters. They can help you, right, with your trade strategy because it's giving you data and it's giving you historical data, even if it's within the same 24-hour period, to then enter your trade on market phase 3. This is where you need to be. So if I'm looking at this trend and it comes up and I'm going to go, okay, it's a breakout, I'm going to buy. Right? That trader wins because right here on breakout, when it broke the trend line, if someone entered a buy, right, then they would have made some money. But if they would have said, well, hold on and wait for retest, this could be, it could be a fake out, right? Not an actual breakout, and it might retest. And it actually seems to me more likely that it would have been a retest. Because look, here we have a little bit of a support and resistance forming. So we have resistance here. And over here, we got a little bit more resistance. We got some wicks forming. We have some smaller bars, which usually indicate price action, right? The bearish movement is slowing down a little bit. So if you look at that right there, this looks a little bit like a resistance line. So in this case, people would say, oh, well, I followed this trend. It broke out. It started to consolidate a little bit, started to get some long wicks, started to get some resistance. Guess what? 90% of the traders that are following price action, support and resistance, and trend line, they're going to enter a sell trade right here. Right? That's where a lot of traders would have entered a sell trade. Guess what happened? Didn't fucking go down. It went up. It went up. Guess the only trader who's making money here. Guess who? The one who got basically lucky by assuming that they're not thinking of the retest, they're just going for the breakout strategy, right? So the retest guys, they lost. The breakout guys, they won, right? But if you go back a little bit, there's definitely going to be some spots where the breakout guys lose and the retest guys win. Guess who wins 100% of the time right here? Market phase traders. People that understand the 3 market phases, and then they use price action, support and resistance, trend patterns, right? RSI, as indicators, right? What 90% of traders are using to actually enter their trades with, their full trade decision is based off of indicators, which is how everyone enters their trades. They use indicators that line up with their trade strategy for them to go, okay, I'm going to enter my trade now. My trade strategy lines up with all the indicators I'm using to make my trade. But the problem is 90% of traders don't understand how the market actually moves, and they don't actually understand the 3 market phases. Because if they did, you would be seeing a lot more traders with like 70, 80, 90% win rates instead of like 50 to 55. And that's still a good trader. An above average trader is winning a little bit more than half their trades. And the reason I win 65 to 75% of my trades is because I follow the 3 market phases and I wait to see where the market's actually going before I enter my trade, right? And even knowing the 3 market phases and even you being able to use all the strategies, a combination trade strategy, which is in my opinion the strongest strategy you can have, is understanding the 3 market phases and then following all price action, support and resistance, trend line, RSI, all these other things to use as indicators, not as your actual entry. Those are just kind of like you're getting your ducks in a row before entering your trade. But the very first thing, the staple, the foundation for you to decide your entry is waiting for the beginning of market phase 3, right? So how do we find market phase 3 here? So if we were a retest trader, there would have been a retest right here, right? So we had this trend line from here down to here, and then it broke out right here. So breakout traders, they enter a buy, they made money. Retest traders, they seen this high right here. They seen price action indicating a potential reversal and that it really is a fake out. Starts to go down a little bit. They're going to enter a sell trade and they're going to lose their hats because boom, it did not go down and went up. Right? So one guy wins and one guy loses. Guess what? Market phase guy wins. You want to know why? Even if it like just a scalp. Right? Like if I'm entering a trade and I'm just doing like a 30-minute or a couple hour scalp, I can win more than 60 to 70% of the time. Right, but with swing trades are usually held open a little bit longer, and you still need to follow all 3 market phases, but you're not going to get 90% accuracy on a swing trade. So if there's someone boasting that they win 90% or more of their trades and you can buy their alerts, I'm just going to give you a fair warning. It's probably a lie. Now, it might not be a lie that they personally win 80 to 90% of their trades, but 80 to 90% of the trades they're winning, they're not sending you alerts for because they're not swing trades. They're sitting there watching the price. They're sitting there watching you, right? They're sitting there watching the market move. They're sitting there waiting for a scalp entry, right? And maybe they win 8 out of 10 scalps. They lose a handful and they win the majority. They're not sending those out as alerts because they're too quick. You got to pull the trigger real quick on a scalp. And especially with certain market phases that don't move very long. Like this market phase right here. This is market phase 1. The beginning of market phase 2 is as soon as it breaks out of the consolidation, starts to move. And this is also the beginning, end of market phase 2 is like right here. The beginning of market phase 3 is like right here. How much room do you have? Well, you could have done a scalp if you were paying really close attention. But this wouldn't even here, you could have made a little bit of a profit on a scalp trade. But could you have done a swing trade here? Well, if you tried to do a swing trade and send a buy signal, right? I'm going to buy DE30 at 1200 right here at the end of market phase 2. And you want to take profit on like swing level, right? Like way up here, like 12.4, 12.6 or something. Back to any of these other zones. It, doesn't look very great. See what I mean? So this is why you have to understand the 3 market phases and understanding how the market's moving and where it's actually going to go based on just 100% prediction based off of indicators is not a strong enough strategy. So 90% of traders out there are winning 50, 55, maybe 60% of their trades, which is good. But they're still losing a lot. And I mean, the monthly gains you can achieve by just understanding the 3 market phases and then incorporating that with your trade strategy of the typical support and resistance, trend patterns, historical data, RSI, price action, all the indicators you use to enter a trade, and obviously how the market moves depending on if you actually do understand how the market moves. Let's say you're really, really good at DE30, the Germany index, right? Yours probably, even though I've only been studying the German 30 for like less than a year, like 4 or 5 months, I bet you I could win more scalp trades on it than someone who's been studying it for 5 years. You want to know why? It's someone who doesn't understand the 3 market phases versus me only knowing this pair for 5 months. I bet you I would win more scalp trades. They would probably get more swing trades, right? Because they've been studying it for like five years plus. It's one of their most powerful one of the most powerful things they follow in their wheelhouse. But if they don't understand the 3 market phases and then you put a side by side and said, let's see who can win as many scalp trades as possible, I might take less trades because I'm waiting for the market to show me where it's going to go. I'm not going to base it off of support and resistance or a trend pattern only or price action only. I'm going to incorporate all those things, plus I'm going to make sure it's entering market phase 3. So how do you know a trade is going to enter market phase 3 and when to pull the trigger on a scalp trade and when to pull the trigger on a swing trade? Obviously, this video is already running a bit long, so scalp trades versus swing trades, that's going to be another video. And then price action, support and resistance, RSI, all the typical indicators that you use. I know we touched on it a little bit in this video, but I have some more important things I want to show you, which is lot size and risk. The risks you should be taking when trading. That's more important for you guys to understand. What's more important is the market phases, a little bit of the stuff we just talked about, like support and resistance and price action and stuff, but then also lot sizes. The lot sizes you should be taking based on what pair you're trading or what thing you're trading, and also how much let's say you have a $1,000 account, how much should you be trading? What risk should you be taking? What lot sizes should you be using? I'm going to show you. Yes, so before we get into what lot sizes you should be doing, how do you spot your entry when following the 3 market phases and using any of the other indicators you use, like support and resistance, trend, price action, whatever? So as I explained previously in this video, market phase 1 is basically a console. So market phase 1 is anywhere where the price is pretty much completely leveled out and it's moving sideways, right? When the market's moving sideways, it's a consolidation. Consolidation is normally market phase 1. 99% of the time. And so right here would be market phase 1. Right here would be a market phase 1. Right here would be a short market phase 1. Here's another one. This would be a very short market phase 1, but it still is. Here's another one. Here's another one. Right? So it's pretty easy to spot market phase 1. It's like a console. Right? Now if we go to daily bar, and it doesn't matter where you go, you'll see it anywhere. See daily right here, market phase 1. And then here's market phase 2 movement, and if you wait to see where the market's going to go, there was a bigger downward movement than there was an upward movement coming off of this market phase 1 here at 10,580. Right? The price is 10,580 here. This is market phase 1 console. Market phase 2 is the initial movement when it comes out of market phase 1, out of a consolidation. That's called market phase 2. Market phase 3 is where you want to decide your entry. So here is where you would wait to see what the tail end of market phase 2 shows you. So what does the tail end of market phase 2 show us right here? So the tail end of market phase 2 shows us resistance on this top bar and then movement down. Now, if I entered the beginning of market phase 3, and here I'm only going to get a scalp, right, on the daily chart. Now, if I go to, let's go back to the hour chart, which is a lot better for scalping, right? Or even like a 30-minute chart's even better for scalping, but I like to do off the 1 hour, because I'll do a scalp trade and I'll leave it open for once it hits my TP, once it gets really close to it, or once it's close to my TP but it's going to start to reverse, then I'll close partial or I'll close the whole trade in profit. And I'm going to do it like 80-90% of the time doing a scalp because I'm following the 3 market phases. So here's a market phase. Beginning of market phase 2 is this initial push, this initial movement coming off market phase 1, right? Now market phase 2 here and then into market phase 3, there wasn't a lot of profit to be made. So we went from right around here, the beginning, and then the end of market phase 2 was like around 1200, 1210. And it only went down to 1185 to 1189, right? So right around here is where I would have been exiting my trade and taking profits based off my entry at the tail end of market phase 2, which was right around here. Once you see a solidified movement and not a lot of resistance, so a large candle like an engulfing candle, another thing we'll get into later, a candle that is like way bigger than the previous candle, especially now. Another thing is engulfing candles, another strategy that people use as an indicator to enter trades. Engulfing candles, again, are not something you should base your entry off of, even if it's the biggest engulfing candle you've ever seen, right? Doesn't matter, because if you're coming at a market phase 1, the very next candle coming at a market phase 1 is always going to be an engulfing candle or the size of one. It's always going to be bigger than the previous candle from market phase 1 because market phase 1's a console, right? Here's the end of market phase 1. Guess what the next candle was? Engulfing candle, right? Bigger than that previous one. But it's because that was market phase 1. So I wouldn't use this candle to indicate. The only thing I'm using this candle is, okay, here's market phase 2. Now I know we're in market phase 2. Now I know there's going to be a big push and a big movement, and you got to keep your eye on it and wait a little while, see where the market's going to take you. So if I was to come here and then maybe it started to move down a little bit, an inexperienced trader who doesn't understand the 3 market phases, maybe you would have entered a sell there. I bet you there were some traders that entered a sell right here. And there's probably some traders that also entered a buy because as you can see, it actually kind of moved up. And then at the beginning of market phase 2, it started to push up, right? But because of this resistance-ish looking zone, pushing up with the resistance on the 1 hour bars, and then it actually started to dip a little bit near the end of market phase 1, I bet you there was a lot of traders that entered sell trades here. Now, they could have got out real early at 11.83 or 8.4 and made a very, very small scalp. And they probably would have got out in a panic because it started to reverse quickly here, as you can see with this candle. But the beginning of market phase 2 is this next really large candle after market phase 1. So now that you know here's market phase 1 and here's the beginning of market phase 2, you're going to wait part way through market phase 2 because market phase 2 to market phase 3 can happen like really quickly, right? It could be 1 second. You could be sitting here looking at this candle and then you're thinking, oh, this is the end of market phase 2, and then it starts to go the opposite direction. So always make sure you're seeing consistency. And this is, okay, so people are thinking, well, what if I was to get in here, I would have made more money. But if you were to get in here not knowing where market phase 2 is going to lead, right? If you entered here in a buy trade, you could have made money for sure. But what if you entered a sell thinking it's going to go down and you didn't have the patience to wait for market phase 2? You wanted to get maximum pips per trade, right? You wanted to be greedy, and then you do a sell trade and you lose because this is right around here. There's not any profit to be made here on a sell trade. It went up. So wait for market phase 2 to begin and watch market phase 2 play out for a little bit. Right? If you're watching the 1 hour bar, give it 10, 15, 20 minutes. Right? If you're watching 5-minute bars, right? Give it 2-3 minutes. Right? Give it 2-3 minutes. Here's a console right here. And look here's another 5-minute bar. Here's 2, 3, 4, 5 minutes. And then you see consistency. So I could have entered right here around the end of this. I would call this the tail end of market phase 2. Right? And I would have done a scalp from a 1, 2, 3, 3, 1. And I would have could have exited anywhere from 1, 2, 3, 1, 1. To 1, 2, 3, 0, right? I could have took my profit around here. That's a really small scalp. So we go back to the 1 hour and the original one we were looking at right here, I believe, or no, we were looking here. So here's the beginning of market phase 2. Here's the end of market phase 2. I would enter my trade here. I wouldn't try to be crazy and predict the market. I wouldn't just try to use price action or resistance or any of that other stuff to decide my trade for me. I'll use it as indicators, but I'm waiting until the end of market phase 2 before I enter my trade. Here's the end of market phase 2. Guess what market phase 3 did? Up, up. So here we went from around 1198, 1199, all the way up to 1216, 1212 to 1216. We could have took profit anywhere around here. And this is right before it re-entered back into market phase 1. Now, another thing you can do is, okay, how do you predict where it's going to end? Well, this is where obviously you use price action, or you wait for it to enter back into market phase 1. Because market phase 1 is almost always in a different spot from the previous market phase 1. Right? So here's market phase 1 right here. And here's the next market phase 1 up here. So here's, again, market phase 1. Market phase 2. Market phase 2 showed you market phase 3 is going to go down. Market phase 3 went down. And guess what? You can close out at the next console or market phase 1. Your take profit goes from 12.065 to 11.95, 11.96. Boom, just like that. Now, here we go. Market phase 1 again. Market phase 2. Market phase 2 into 3 is going down. Right? This was almost not quite a market phase 1. This one just continued on going down. And here's your next market phase 1 right around this area. Even if you waited for here, right? It's like almost market phase 1, almost market phase 1, a very clear console and a market phase 1 at 1180. And where'd you enter? Right? You entered at 1205 or you entered at 1195 and you took profit on a sell at 11.8. Right? And if you're doing a larger lot size, right? If you're doing a small scalp trade, you can increase your lot size by a little bit when you're doing scalps. If you're doing swing trades, right? A trade that's going to go from like 11.6 up to 12.6 or 12.4, you need to do a smaller lot size, because if you lose that trade, even a 0.01, that many pips is going to crush your account if you have a small account, right? So scalp trades, you can do a little bit like a hair bigger. I would say if you have a $1,000 trade account and you're doing swing trades and you're doing standard currency pairs, right? Like USD CAD or Euro CAD, right? Or GBP odd, then you could do 0.01 to 0.03 per 1K. That's what I would do. Some people can do up to 0.05 or 0.06, because technically that's around 2% of your account or 5% of your account, right? But if you're risking 5% of your account and you're opening up like 5 trades in one day, now you're risking 25% of your account, 10 to 25%, you know, and that's a lot. Because if you lose the majority of those trades, you could lose 10 to 20% of your account in one day. The drawdown on that is hard to recover from. This is why it's better to do smaller lots, but open up more trades. And also doing scalps. You can open up multiple scalps, do a little bit bigger lot size, and you're going to be able to make a lot of money doing scalp trades following the 3 market phases and then using price action to indicate where market phase 2 is leading into market phase 3. This is the most reliable and best way to trade. Why no one's teaching it and why most traders don't do this. This is probably why you might hop from one trade alert program to the next, to the next, to the next, because not a lot of traders, and this is me, and I've been trading for a few years. Now, I haven't been trading for 10 years, right? There's people that are way better than me. There's people that have been trading a lot longer than me. But what's crazy, if we sat down side by side and we scalped together, if you don't know the 3 market phases, I already have a huge advantage, because I'm going to wait for the market to tell me where it's going. I'm not going to try and predict it. I'm going to let the market say, hey, this is where I'm going. I'm going to enter my trade. I don't care if that only goes from here to here, right? 1207 to 1196 or 1195. Not a massive pip gain, right? Right? Not a massive pip gain. Guess what? I still won the trade. I still made money because I waited for the market to tell me where it's going. And then you don't got to worry. You don't really have to worry much about support and resistance. You don't have to really worry much about the RSI. You don't have to worry about fall and trend patterns, because there's always, always, always going to be market phase 1, 2, and 3. They're always happening. As you can see, if we just keep going back in time, no matter what, you will always see market phase 1, 2, and 3 happening. It's always happening everywhere you go. Right now, you're not going to be able to always enter a trade at the tail end of every market phase 2, because if you look here, this market phase 1, this console lasted a while, and market phase 2 jumped into market phase 3, and it quickly went back to a console and into a market phase 2 again, right? But if you waited a little while and entered into this market instead, this market phase 1, market phase 2 tail ends right here. We got a bigger bar right here, an engulfing candle. So this is where price action and support and resistance in RSI does come into play, but it is not going to be what tells you how to trade. The market phases are what's telling you how to trade. Using the other crap as indicators, not as choice makers, right? So end of market phase 1 to market phase 1 here. You're trading in between 1 and 1. You're trading on the tail end of market phase 2, and you're making your profit on market phase 3. And this is where the banks, hedge funds, the best traders in the world are making their money. It's called smart money. And all the dumb money, people who are inexperienced or even experienced traders who are only winning 55%, well, guess what? They're losing 45% of their trades. So when other traders are losing 45%, maybe you pick up an extra 10 or 20% in wins because you're patient and you watch the 3 market phases and the movements. You understand how the market moves, you win, right? Now, there is no way to beat the market 100% of the time, but if you look here, there is only 1 spot, maybe 2, that I wouldn't have entered a trade. And let's find 10 spots to give us a nice solid round number. 1, 2, 3, 4, 5, 6, 7, 8. Okay, hold on. Let's go back again. Let's go back a little further. 1, 2, 3. Let's go this one. 4, 5, 6, 7, 8, 9, 10, or 10. Okay, so we have roughly 10 market phase 1s in this screen right here. We got about 10 market phase 1s. Let me get rid of this confusing trend line. So we got 10 market phase 1s sitting in front of us. Oh, trading view doesn't want to work right now. Okay, so yeah, let's remove that. Thank you. So we have 10 market phase 1s, and I'm going to find 1 or 2 that I would not have want to enter on, but I guarantee the rest of them, like 70 or 80% or more, you would have been able to enter and make money on a trade. And this is how we do our trade alerts. The reason why we're doing 65 to 75% win rates is because we're following the 3 market phases. And it's a little harder to get in on a swing trade, but we're still doing it, and we're doing it very consistently, and we're doing extremely well with it. And I'm not saying that we have the best alerts in the world, because maybe there's people with better win rates, but I bet you the guys with better win rates, maybe they have a few days or a few weeks out of the month where it's really bad, right? Compared to us, where we'll have like 1 to 2 bad days, and we'll recover almost immediately or within a same week. We don't need a month to recover, right? If we have a bad day or a couple bad days, or even a bad week to me is a few percent loss, or like only a 1 or a 2% gain, right? A very, very small gain or a very small loss is still not a great week, because you're not making a lot of profit, right? You're not having good gains. And it doesn't take long to recover from that. And that's the power behind the SupremeCommerce FX alerts. So if we got 10 market phase 1s here, that means there's 10 market phase 2s and 10 market phase 3s. The only one that would not have been good to enter would have been for sure right here, right? You still could have, and you maybe could have got a really tiny scalp right here, but this thing moved so quickly, right? And then it bounced back a little bit, that this would have been a difficult one to do. So seeing how this one went and how long it consolidated for, how long market phase 1 lasted, this would have, you still could have made money here, but in any case, this would have been one that would have been a little bit harder to make a profit on, right? But then we have this one. These two are absolutely unbelievable. These are, you could have made money on both of these, right? Solidly. So here's a market phase 1 right here, right? We got a console / market phase 1. And at the very tail end, market phase 1, we enter market phase 2. Market phase 2 starts moving, and it makes it very clear it's going to push down, right? The market's literally telling you right here, right? It's going down. There's not very long wicks, right? Not very many long wicks. It broke past this little mini resistance line, which would have been like right here. As soon as it broke past here, which it did, so support and resistance does obviously come into play, because you can use it here as an indicator, right? But if you look right here, RSI says, if people follow RSI, normally when it goes outside of RSI, you wait for it to come back and then you buy. So right here, maybe it exited RSI and people would have thought, oh, maybe I should buy here, right? It exited the bottom of the RSI. I should probably do a buy because it's going to come back up. But let's see, if we took a buy here or a buy here or even a buy here when it was approaching back, look what happened. It went way down. It could have crossed your stop loss and you could have lost your money. You could have lost that trade, right? Just trying to do off support and resistance in RSI. Understanding the 3 market phases, RSI in this case doesn't matter because it's going down according to market phase 2 and market phase 3. So I personally would have entered a sell trade here at the end of market phase 2. Market phase 3 took me all the way to the next rate, all the way around in a circle, a perfect circle from market phase 1, 2, and 3 back to 1. Here we are, here's 1. Here we are, here's 1. Market phase 3, look at the sell trade. We would have been able to get mad pips. Then, again, we catch another market phase 1, entering market phase 2. Not crazy long wicks. Market phase 3 starts to push down. Candles get bigger. I enter a little late. Don't care because market phase 3 tells me where we're going. I enter a trade somewhere around here. I'm catching some fat pips until next market phase 1. Right? Now we have this next market phase 1. It actually started to move up into a market phase 2 and 3. But again, this would probably be another market phase 1, 2, 3 that I would not have entered. Kind of like this one. Would have been hard to catch pips, right? It would have been hard to catch pips right here. But if you waited for a market phase 2 to give you a stronger movement, right? Market phase 2 movement is your strongest indicator on what's going to happen with market phase 3. If market phase 2 starts moving strong and it move into market phase 3 here and then a strong push up, not as strong as this push and not as strong as this push, right? But from here to here is still pretty good. You can definitely catch some nice pips just by waiting a few minutes or 30 minutes or an hour or whatever and wait to see what market phase 2 tells you what's going to happen with market phase 3. And as you can see, it makes it very clear. We're going up, right? And we bottom out or we top out and then we console again. But guess what? From here to here, nice pips. And then again, market phase 1, enter market phase 2. Market phase 2 starts pushing down. Not a lot to be gained here, but if we go from the beginning of console market phase 1, 12.05 to 11.95, that's still a good gain, right? Not a big one. Nowhere near as big as these ones. But guess what? We won this trade. We won this trade. Even if we exit early, even if we enter late and we exit early, we're still going to profit because we're waiting for the market to show us where it's going. Got what I'm saying here? Okay, awesome. So then we got it again. I don't know where I left off. So not a great amount of pips here, but then here we go, market phase 1, entering market phase 2. And we almost entered another market phase 1 or a console here, like a tiny little bit. But because it was still moving down, right, it didn't actually completely flatten out and move sideways. It still continued a downward movement. And then on this fourth bar, it actually started to move down again. You could have entered here or you could have entered here, right? Let's just say for safety's sake, we entered here. We waited for that big push into market phase 3. We're going from 11.84 down to 11.67 for the next console zone. We even could have waited for this console zone, which is 11.78, and we enter at 11.86. We're still catching profits from there to there, right? Very small. But there's like 7 out of 8 trades won by waiting for the market to show you where it's going. If this isn't blowing your mind into all the shit you've learned about Forex and having to do support and resistance, RSI, not once have I referenced RSI in those 7 out of 8 trades that I would have won following the market phases, right? I only referenced RSI once, and the RSI actually did the opposite of what I wanted it to do. RSI was saying exit, it's probably going to come back, and it eventually did. But if I was to enter right here where it broke RSI, where a lot of inexperienced traders who think they're good traders try to enter a buy trade, oh, it exited RSI, I'm going to do a buy. It's going to come back in, it always does. That's what everybody online says. And then they lose money, and they go, what the hell, RSI is a joke. No, RSI is great, but it shouldn't be the only thing you use to judge your fucking trade or choose your entry, right? So here we are on an additional market phase. So here we, very small pips from there to there. I think where the next one was, I think we were here to here. So here's another one there to there, very small, but we could have caught pips. Oh, here's where we were last. So this is like 7 out of 8 trades won, and we didn't even lose. I wouldn't even have entered this one, potentially. I don't know, maybe I would have, and if I did and I did a scalp, I still would have made money. But just for the sake of this, let's call this a loser or a non-profitable trade, this zone. So I've taken 8, and I've lost 1, or I did not enter 1, right? So then here we are again, right here. We are now at this zone. We're going to enter another trade. So market phase 1 is ending. Market phase 2 has begun. Market phase 2, we let it roll for a little while. Like I said, 15, 20 minutes, even an hour on the hour bar chart. Wait to see if it's going to enter another market phase 1 or if market phase 3 is going to give you a big push. Market phase 3 gave us a big push. We went all the way up here, started to see the biggest wick was here. So we started to see a little bit of resistance, and we started to get a smaller candlestick, and then an even smaller candlestick, right? Price action, again, still a factor. You still have to know these things, the fundamentals, but they're not the only thing you need to use. Market phases are what you need to use. So price action tells us right here we might be entering a market phase 1 console again. So I probably would have exited. But from here to here, that's a nice gain, right? 11.8 roughly, or 11.810, all the way up to 12.05 or even 12.10, right? If I exited a little early just to be safe, 12.10. Still a very nice gain. And then again, if we enter to buy here, market phase 2 says market phase 3 is going up. We wait for a while. We watch where the market's going instead of trying to predict it. Let us tell it where it's going to go and then enter. Even if we entered late and then we stopped at that next market phase 1, let's say we entered way up here, 12.156, and we exit at 12.26, right? Another nice little gain. So in the period of 2 days, we would maybe have one swing trade, right? A swing trader, they'd have maybe entered one. And they got a pretty decent chance of winning, or they might just as good a chance of losing their trade if they're entering a swing trade, not following the 3 market phases. I mean, even like really good traders, but who don't know the 3 market phases, their best chance of winning trades is like 50, 55%, 60%. And that extra 5 to 10% is literally only because they've been watching that pair for a long time. Only because they've been trading it so long. And additionally, they might just be doing scalp trades and holding and taking profits on small pips just to solidify profits. And then they consider themselves a really good, really well-experienced trader, but they don't even know the 3 market phases. So here we are over here, not giving a shit about support and resistance, not giving a shit about the RSI, right? I keep it in the back of my mind because I have a combination trade strategy, which is based on the 3 market phases, but I'm also including price action. Support and resistance is a factor, because if we're approaching the end of market phase 3, and I notice it's also around the end of a previous resistance, then I might want to exit, because that resistance indicates to me 2 times the chance that it might be entering market phase 1. But I always like to wait until the nice tail end of market phase 3. I'll even wait until market phase 1 starts again, which is another console, market phase 1, and then I'll exit. Right? It's always ideal to exit at the best point possible and enter at the best point possible, but that's not logical, right? You're never going to be able to always, ever, 100% of the time, enter at the best point and exit at the best point. Your best bet is to follow the 3 market phases, use support, resistance, RSI, price action, all of these things, trends, whatever, all the things that you use in your normal trade strategy, but follow the 3 market phases. Once you implement this into your trade strategy, watch your win rate go up. I guarantee that if your win rate doesn't go up by at least 5 to 10%, you need to come back and watch this video and understand how the 3 market phases work. All right, so video's running a little long. I want to jump to this next thing, super important for you guys. So risk size, what size risk should you be taking, and what size lot sizes should you do depending on what you're trading. So if you got a $1,000 account size and you're trading standard Forex pairs, you should be doing 0.01 to 0.04. Now, you shouldn't do 1 trade with 0.01 and 2 trades with 0.04 and 1 trade with 0.02. This is just a ballpark range. The closer you get to 0.04, the larger risk you're taking. So if you're a brand new trader, start with 0.01, maybe 0.02 for 1K account size for standard Forex pairs, right? And the more trades you open, let's say you have 5 or 6 open trades, at that point, I would actually start to drop my lot size by a little bit, because if you open up 5.03 trades and then you get another trade alert, let's say from the SupremeCommerce FX trades, like our trades, and then you got 5 open, 6 open, 7 open, I would probably drop the lot size by a 0.01. If you're doing all 0.02 or 0.03, drop the next one by 0.01. Just because if you got 10 open trades and they're all 0.03, you're just exposing yourself to the possibility of losing more, when if you enter your first 5 or 6 trades with the same lot size, and then the next couple ones you get, if you do that same lot size, technically you're taking a little bit more risk, right? Because you're doing more trades. Right now, 1 trade on 1K account at 0.03, you might be able to only get like $10, $20, or $25 profit in a trade on a $1,000 account. It doesn't seem like much, and that's around 2%, which is what I recommend risking. But if you're opening up almost 10 trades, I would recommend dropping the lot size, because now you're not just risking 2% on 1 trade, you're risking 10 trades at 2% each, which is now 20%. You're entering in riskier territory, right? So the only time you should drop your lot size is when you got a bunch of trades open. Another time to drop your lot size, other than standard Forex pairs, is when you're trading pairs with JPY. JPY have larger pip sizes, so if you get 10 pips on a JPY trade and 10 pips on a USD CAD trade, you're going to make more money on a JPY pair trade. right? If you do a 0.03 on both. So if you do a 0.03 on USD CAD and 0.03 on JPY, you're risking more with JPY. You're also in a position to make more, but it's a larger risk. So with JPY pairs, I will do 0.01 to 0.02 per 1K, right? Or I would do 0.01 smaller than what you're doing per 1K with your other ones, right? So if you're doing 0.02 on your 1K for standard Forex pairs, I would do 0.01 for JPY. If you're doing 0.04, I would only do the max of 0.02, right? So that's what I would do JPYs. With indices like Germany 30, US 500, they carry an even larger risk size than JPY pairs do because of how huge the movements are. So I would do 0.01 per 1K, right? And I didn't put 0.02 here for a reason because, I mean, it's larger risk than JPY pairs. So 0.01, and some might think that's extremely modest, right? And the reason why you want to be modest is because of the drawdown. Now, drawdown is when you have a losing streak, even if it's 1 day, 2 days, 1 week, right? Recovering from drawdown is what destroys most traders and what makes most traders, after a good month, they have a bad week, they give up, or they sell their company, or they stop, and new traders stop trading because they go, well, what the heck, right? And that's because you're taking too big a risk. Now you have a $1,000 trade account and you're doing 0.04 on your Forex pairs, and then you go do a 0.04 on an index like Germany 30, right, DE30, and it's like $150 loss. Or a $150 win could get you really excited. And another thing is trading, you need to have no emotions. It's all based on an analytics, right? Analysis, market phases, and your indicators, and making money by being smart, not by being emotional, right? No business needs emotion, right? Not just trading, but trading needs to be the most emotionless business model, because when you include emotions and you get excited because you did a good trade, you're probably going to be more geared towards taking larger risk. And the more risk you take, when you do lose, you're going to be real upset. You're going to be bummed. You might even give up. And I highly suggest, if you're trading, do not give up on trading. Another thing is, if you're taking alerts, like to this day, 3 years later, I have my partner from the UK. He's been trading for 10 years. He's an expert with indices. I'm really good with Forex pairs. He's really good with indices. So I will once in a while say, hey, I'm going to enter Euro USD on a buy. And he's going to go, even though this guy's been trading for 10 years, he's going to take my advice of 3.5 years of trading, and he's going to enter that trade with me because I'm better at that than he is, and then vice versa, right? He's really good with indices, so I'm going to take his trade because I know he's better at it than me. So no one can be a master of all, but it's definitely good. I will pay him for the rest of my life. Until I become a master of indices myself, I would always be willing to pay someone for trade alerts, because as long as they're good, right? Proven track record. So give it 30 days or 60 days, right? Once you see that you're making money every month, not every day, not every week, but in a 30-day period, if you have gains, they're probably a good trader. So what I would do is, after 30 to 60 days, is even 5 years from now, I'm a really good trader. I make so much money with it, right? I'm doing extremely well. Like, for example, now I do extremely well with Forex, and that's why I created the SupremeCommerce FX alerts, right? Is we're doing so good. And I understand a lot of the stuff that 90% of traders do not. This is why our trade alerts do so well. And another thing is, because there's other traders that are really good at what they do, I would always be willing to take a look at their trades they're taking and maybe even pay them. Be like, hey, here, yeah, I'll give you $100 a month if you send me all the trades you're taking, because I'll nitpick all the trades that I will take out of your expertise, right? So I personally, even though I've been trading for over 3 years, and even though I provide trade alerts, and even though have my trade strategy and I'm a good trader, I am still open to paying someone else to take their trades, because if I could have 25 open trades this week compared to like 5 of my own, why would I not do that, right? Why would I not do 25 trades in a week? And if I'm going to have, like, let's say a 60 or 65 or 70% win rate, which is extremely good, and I get to do it on 25 trades instead of just 5, why would I not do that, right? So for $50, $100 a month, whatever it is, I'll pay for alerts for the rest of my life. Now, currently, the only person I ever actually take alerts from is my partner from the UK, who gives me the indice trades, which is what you guys are getting. So you're getting me. I'm really, really good with Forex pairs, and he's really, really good with indices, right? I'm also really good with Bitcoin and Ethereum. Now, we have not yet, as of summer 2020, released the cryptocurrency trade alerts to SupremeCommerce FX, because I'm waiting to be as good with it as I am with Forex pairs. Once I have solidified like a 70% or greater win rate, and not just with scalps, with swing trades, because swing trades can be sent as alerts because you got a lot of time for the trade to hit its final point, right? Its take profit or whatever, and you have a decent amount of time sometimes to enter the trade. But with scalp trades, you need to get in there right away. So I do a lot of cryptocurrency scalp trading, and I'm getting more focused and geared towards doing swing trades like I do my Forex pairs, which is how you get alerts. The best alerts are swing trades because you have time to enter them. If you're in a different time zone, you wake up a few hours later, you still have time to enter that trade, right? But with scalp trades, you normally do not. So until I master swing trades with Bitcoin, which I'm getting really close to feeling confident enough to give it to someone else, right? So we've been teaching people since 2016 in SupremeCommerce, eBay, Amazon. We've got the only zero ad cost Shopify training in the world. I wait until I've absolutely mastered something and until I have proven to myself it's a long-term sustainable business model and that someone with absolutely no experience can do exactly what I'm doing and I can show them and they can almost guaranteed succeed as long as they take action. So until I am confident to that point, like for example with Bitcoin alerts, I will wait. I will wait until I'm 100% confident and only then will I provide it. So with SupremeCommerce FX alerts, you are in a really good place and you're in the right hands. So larger trades, it's possible to do, but the drawdown is higher. So to recover from a bad day or a bad week is really hard if you're risking more of your money, right? Because you can blow your whole account. So what we do is go for 10 to 50% a month. 50% is a lot. 10% a month, also a lot. 10% a month is 120% a year. That's insane. Right, and that's just 10% a month. And a bad month could be like 6% or 7%. And then you have a good month, which is around 50, sometimes 70% gains in a month. Right, like I've taken a 1.5K trade account and I've taken it to $4,500 in 3 weeks. So that's like 250, 300% in less than a month. Right, but that also includes scalp trades. With swing trades, I've taken a 1.5K account to a 3K account in a month, which is 100% in a month with just swing trades, which is what I send alerts out for. So we modestly aim to go for 10 to 50% a month. And what you can do, and this is the reason why we do smaller lot sizes and why you should, is because that's the right trade strategy, right? And following trade alerts and doing it that way is the best way to do it. Now you could do larger trades and take more risk and go for maybe 50 to 200% month gains, right? But if you do that and then you lose, right? You have a losing streak. You can lose your entire account. You can lose your entire account in like a handful of trades, right? And if you doubled up on your Forex pairs, so per 1K, if you did 0.04 to 0.08, and then you lose 5 trades in a row, you could lose like $300. That's 30% of your account. If you do like 0.1 or 0.2, and you only got a 1K account because you want to be crazy and try to make as much money as you can in 1 month, which is the opposite of what a trade strategy should ever be, you can lose your entire account and then you're never going to want to trade again. But if you give it a month, 6 months, 1 year, and then you see you've gained 100, 300% in a year, right? And then you do it again, and then you do it again, and then you do it again. This is how you build absolute massive wealth through compound income with day trading. And this is the absolute necessities and the stuff you guys absolutely need to know when it comes to trading. So again, any questions you guys have about trading? I know there's a lot we went over in this video. You can watch it again. You can drop a comment below and I'll answer any questions you got. Also, the SupremeCommerce FX alerts, we are offering 3 to 5 of the 5 to 20 alerts a week we send. So we send 5 to 20 alerts a week. We're offering 2, 3, or 4 a week for free. If you go to our Instagram and follow SupremeCommerce FX. So in the comments below in the description, I will add our SupremeCommerce FX Instagram handle. And any questions you guys have, you can drop them below. Don't forget to like and subscribe, and we'll see you next week.